Now, it's time to get your entire financial house in perfect order and keep it that way forever. This is the Victory, Wealth, and Wisdom Show with your host, James Hait.
Hello there, I'm James Hait with Victory Wealth Services. Welcome to the program. Now, before we start, I'd like to say a few words about the content of this particular show. Because of the current political climate, today's topic can seem divisive for many. However, this show is and always will be politically neutral. We're not going to take sides or have you or attempt to make you take sides as well on any position or political issue or endorse any candidate, party, or public policy. What we do is we respect the rights of others to make their own decisions in political matters. This is not a political show. It is a math and logic show. It's about current events and how they could potentially impact you and your retirement. Now, isn't that refreshing? Well, do you appreciate what you're learning today and all the valuable information? Well, then by all means, subscribe. Just click on that subscribe, the like, the alert buttons below so you can stay up to date on current financial events and topics. It's free, it's easy, and it can have a positive impact on your life. So let's get right into our topic today. It's all about the big tax bite that's about to come down on Americans due to the $2.2 trillion infrastructure plan. We've had out of control spending with the government over the last year, and by all accounts, some of it was very, very desperately needed. But really, since the shutdowns last year ground the economy to a near halt, Congress and the Federal Reserve have pumped trillions of dollars into programs aimed at fighting the coronavirus and bailing out industry and small business, in essence, to save the economy. So let's think back just for a moment. March 27th of 2020, the historic CARES Act was signed by President Trump. That put $2.2 trillion of stimulus money into the economy. Then he added another $900 billion in a stimulus package. That was the second largest federal stimulus package in history after the CARES Act. And now, on March 11th of this year, 2021, the House and Senate passed the American Rescue Plan, a $1.9 trillion plan to combat the coronavirus and stimulate the economy. That massive coronavirus relief package is now law. But now, President Biden is laying out his next big proposal, a roughly $2 trillion plan dubbed the American Jobs Plan. And that's to improve the nation's infrastructure and shift to greener energy over the next 8 years. Of course, the media is going bananas over this, whether they're for or against the plan. Notice what Bloomberg reports, that Biden eyes his first major tax hike since 1993. CNBC calls it the Super Bowl of tax reform. Now, to be sure, the nation's infrastructure is sorely in need of repair. But the sheer amount of money to pay for the infrastructure plan and matching tax hike are hard to fathom. So how does all this money break down and stack up? Well, to begin with, we have transportation, $621 billion, home health care services and workforce, $400 billion, manufacturing, $300 billion, research and development, $180 billion, water, $111 billion. These were with a B, billion, $18 billion for veterans, hospitals, and federal buildings. $1 billion here and $1 billion there. Pretty soon, you're talking about a lot of money. So, how is this $2 trillion infrastructure plan supposed to help the economy? Well, in theory, investing in all of these projects will help the country's crumbling infrastructure. It's supposed to stimulate economic growth, which leads to new job creation, building factories, research, development, and so on. Well, that makes sense, right? But on paper, investing in the country to this magnitude, when we think about it, should hopefully spur some unprecedented growth in the economy. Everybody wins. But what's the expected return on our investment, or ROI, of this $2 trillion government loan? Well, okay, what are you talking about? Return on investment, James. What do you mean? Well, think of it this way. Let's say that you own a coffee shop, And if we do the math, 1 cup of espresso, including our supplies, the beans, the employees, your insurance, the rent on the building, you name it. Let's just imagine for a moment that cost you, the owner of the coffee shop, 50 cents to produce. Now, you turn around, you sell that cup of espresso for $2.50. That's a $2 profit. That's fantastic. That's a significant return on investment, ROI. But we're not talking about a cup of coffee here. We are talking about $2 trillion. And when it comes to the economy, one hopes that such a huge investment would have a high return, or at a minimum, break even, right? Well, notice this 2016 report that was prepared by the Congressional Budget Office, or the CBO. In this report, it said that federal investments deliver only half the economic returns as the private sector investments do, 5% versus 10%. The report goes on to say that $1 of federal spending results in only 67 cents worth of actual investment. Think about that. Now, the reason for that is because private sector entities reduce their spending in response to federal tax dollars. Now, in addition, the report says that the federal investment financed by debt or taxes could do more economic harm than good because federal borrowing and taxes crowd out investment. To avoid harming the economy, federal investments should be financed by cuts in other discretionary programs. That's all according to this report. And what this report is telling us is that it's improbable that the country will break even at all. So the question many people are asking is, do the benefits of Biden's $2 trillion infrastructure plan outweigh the $2 trillion tax hike to pay for it? After all, there's only 3 ways to cover the cost of federal investment. You can increase borrowing, raise taxes, or reduce spending. Some analysts are worried that this administration has chosen the most economically harmful method of financing. But what do you think? Do you think the benefits outweigh the taxes? I mean, we're all watching this unfold on the news every day. Perhaps you're asking yourself, but what can I do about it right now? How can I protect myself and my financial future, regardless of where tax rates land in the future, irrespective of what political party controls the White House or Congress? Right now, so much feels out of control. But the reality is your finances and your retirement that you've spent a lifetime preparing don't have to be. You can completely control those things, and you have more control than you may think over what your tax picture looks like in retirement. That's why we are having a virtual tax masterclass, and you're going to learn all about this. During this masterclass, we'll talk about several big picture strategies that can help you take control, protect yourself no matter what happens to future tax rates. And we'll talk about 3 actions that you can take and make those strategies part of your overall comprehensive financial plan, taking you to and through retirement. And don't worry, you don't need to be the head of the Federal Reserve to understand these strategies, because in plain, easy to understand language, we'll detail how you can implement any of these powerful strategies. Simply click on the link in the description or visit us at victorytaxclass.com and sign up for the time that's convenient for you. Don't spend another day trapped in uncertainty. Empower yourself with the knowledge that you need to be victorious. Now, getting back to our program, how is this massive infrastructure plan going to be funded? Well, in a word, taxes. Lots and lots and lots of taxes. Let's talk about 3 significant tax hikes that could potentially affect you. The first one is the most prominent. We're seeing it all over the news, and it's the biggest tax bite of all. That's the corporate tax hike. Now, it's true that under the American Jobs Act, the federal corporate rate will rise from 21% all the way up to 28%. However, this is not the complete picture. Look at this chart. If you count the U.S. federal state combined tax rate, now we're talking a whopping 32.34%. That's higher than every country in the OECD, the G7, all our major trade partners and competitors, including China. But what do you think? Could this harm the U.S.'s economic competitiveness and diminish its role in the world? It's possible. Now, you may be watching this and thinking to yourself, I don't own a corporation. Why should I care? I'm even retired. Well, we should care because when corporations get hit with tax hikes, it ripples through the entire economy. High marginal tax rates can discourage work, savings, investment, and innovation. Specific tax preferences can affect the allocation of economic resources. That impacts everything from your retirement portfolio to what you pay for groceries to your iPhone. Now, before we all jump on the let's cut taxes bandwagon, consider what happened the last time that we had a major tax cut. That was the Tax Cuts and Jobs Act that was intended to encourage hiring, building factories, research and development, thus pumping money back into the economy. But that's not necessarily what happened. Instead, for the most part, these huge corporations decided to spend their money and spend the tax savings that they had on buying back their own stock, thus pumping up outstanding shares and enriching the executives and the shareholders. They did this to the tune of $5.3 trillion over the last 10 years. Analysts say that buybacks have been the driving force in the decade-long bull market. Sometimes these large corporations even go into debt to make these massive buybacks. They're making a shaky situation even more volatile, especially if a market correction takes place. Now, of course, an argument can be made both for and against buybacks, but the reality is they are part of the financial landscape right now and don't seem to be going anywhere. This is another reason that we see the markets at an all-time high while the economy seems to be in a death spiral. Despite what large corporations are doing, the Tax Cuts and Jobs Act has positively impacted some individual investors and small businesses. A study conducted by the Tax Policy Center found that 65% of households did receive a tax cut in 2018, while only 6% paid a little bit more. Higher income taxpayers obviously reaped the most significant tax savings from the act because, individual tax rates were significantly reduced. Now, simple math dictates that folks who pay heavy taxes benefit the most from that change. But on the flip side, you could be one of the ones that didn't benefit from the Tax Cuts and Jobs Act. How so? Well, suppose you live in a high tax state and have lots of home mortgage debt. In that case, you could be losing out because the act imposed new limitations on itemized deductions for state and local taxes and home mortgage interest expense. Now, since we're on the Tax Cuts and Jobs Act subject, we can't forget one crucial fact. If you pay attention to anything in today's program, this is it. Ready? This is your documentary moment to write something down. The law is due or set to go away or sunset on December 31st, 2025. That's when income tax rates will reset back to 2017 levels. What does that mean for you? Well, for the past several years, you may have been benefiting from historically lower income tax rates. But once that law expires and tax rates revert back to 2017 levels, you will see the opposite of one of the biggest tax cuts in American history. You'll see one of the biggest tax hikes in U.S. history. Why is that? Well, because the lion's share of individual investors' portfolios is in tax-deferred accounts. You know what I'm talking about: IRAs, 401ks, 403bs, TSPs, your company plan, whatever retirement plan that you have. And taxes have never been paid on those assets. And millions of people are enjoying relatively low taxes on the withdrawals from these or hope to in the future on these accounts. But that's all going to change in 2025 when the tax rates go up and your retirement paychecks go down. Many could find this financially devastating. Now, this is why chances are you've probably seen more and more ads on the internet, books, articles, news coverage, whatever the case may be, all about this tremendous impact that this is going to have on families, because it is going to be significant. In fact, one of my favorite books, a landmark book, it's called The Power of Zero by best-selling author David McKnight. He calls this event the tax train. IRA expert and celebrity CPA Ed Slott calls it the retirement savings bomb. Others have called it the tax storm, and so on. But come on, that's kind of an over-exaggeration, don't you think? Perhaps a bit hyperbole? Well, maybe. But I don't think it's enough of a warning for the American public. I don't think enough could be said, which has inspired me to write my own book. What do you think of my working title? One that's sure to shine an even brighter spotlight on the looming tax shift in America. I call it The Tax Bomb, Taxnado, Tax Storm Countdown to Taxamageddon. Too much? Maybe? Well, but the fact of the matter is this. Taxes right now are going to be going up. But currently, before that happens, right now, they're on sale. That sale will only last at most until December 31st, 2025, or it could disappear altogether with new legislation from the current administration. So, here's the multi-million-dollar question. How can you take advantage of this fading opportunity before it's too late? Well, many experts feel that the best way is to create a plan to systematically move funds from your income taxable accounts and your tax deferred accounts over into tax-free accounts. Now, what do I mean by that? Well, typically there are three types of money that we have. What are they? Well, think of them like buckets. The first bucket is our income taxable bucket. Included in this bucket would be CDs, your non-qualified stock portfolio, your savings account, and so forth. The tax-deferred bucket includes things like IRAs, 401ks, 403bs, your TSPs, any company plan that you have for retirement. And finally, we have the income tax-free bucket. It includes Roth IRAs, certain types of life insurance, you name it. There's lots of things that can go into this income tax-free bucket. Now, the goal is to move as much as we can from the taxed buckets, the income tax and the tax deferred buckets, over into the income tax-free bucket. Or, as Ed Slott loves to say, going from forever taxed to never taxed. But how do you know which of these accounts to start converting and by when? You see, this is something you do not want to get wrong. Typically, you get one shot to make this right. And if you don't have a solid tax plan in place, the consequences could be very unpleasant. You want to be smart about this. Now, that's why we're hosting a free virtual tax masterclass. During this masterclass, we'll talk about, again, those several big picture tax strategies that can help you take control, protect yourself no matter what happens to taxes in the future. We're going to talk about 3 actions that you can take to make those strategies part of your comprehensive financial plan, taking you to and through retirement. And again, you don't have to be Albert Einstein to understand all this. In plain, easy to understand language, we'll detail how you can implement any of these powerful strategies. Just simply click on the link in the description or visit us at victorytaxclass.com and sign up for a time that's convenient for you. Okay, now let's focus on a second and a third way the Biden administration is considering raising funds, which are through changes to the estate tax and the stepped-up basis rule. The first would affect only multimillionaires, but the second could have an impact on more modest estates and their heirs. So let's start with the estate tax. Currently, the exemption for an individual is $11.7 million and $23.4 million for couples. However, that could possibly change back to pre-Tax Cuts and Jobs Act level of only $3.5 million. Now, that will impact a lot more people than you can imagine. I mean, for many, just the skyrocketing housing market and housing prices can quickly put one over the top and force your heirs to have to pay federal estate tax. But right now, we're experiencing, on top of all of this, really the most significant transfer of wealth in history. As the baby boomer generation passes away, the next generation who inherits this wealth will get stuck with an unfathomable bill. Finally, a third possible tax change is how property is valued when it passes from an owner to a beneficiary. Cost basis is the monetary value of an item for tax purposes. Now, when determining whether a capital gains tax is owed on a property, the basis is used to determine whether an asset has increased or decreased in value. Let's take a look. Imagine you purchased Tesla stock way back in the long ago, and you bought it for about $50 a share. That's the cost basis, $50 a share. But if you later sell it for $673 a share, which as of April 7th, that's what it was, you must pay capital gains on the $623.07 in increased value. Under the current law, though, when a property owner dies, the cost basis of the property is stepped up. That means the present value of the property becomes the new basis. Let's take a look at that Tesla stock again. Here we paid $50 a share, we held on to it for many years, and it grew in value to $673. If that was the value when we passed away, the cost basis, or for tax purposes, is stepped up or reset to the value of the stock on the day that we pass away. Our beneficiaries would not have to pay capital gains taxes on the growth of the Tesla stock. Now, according to an article in the New York Times, the current administration may propose to eliminate that basis step-up rule altogether. In other words, the cost basis would be the same as when we originally purchased the stock, and our beneficiaries would have to pay the capital gains on all of that growth. Now, here's another example. Suppose you inherit a house that was purchased years ago for $50,000, and it's now worth $250,000. You'll receive a step up in the original cost basis from $50,000 to $250,000. And if you sell that property right away when you inherit it, you will not owe any capital gains taxes. See, in the past, it was difficult to determine the original cost basis of some properties, but in the digital age, that information is more easily gathered. So this change could result in taxes increasing for some people inheriting property that has risen significantly in value. That could drastically impact your legacy and what you're truly able to leave to your beneficiaries. Now, another question is this: if these changes are going to be made retroactively or not. It's unlikely, but it's possible that if Congress changes these rules later in the year, they could be made retroactive to the first of the year. Now, as we experienced repeatedly, it really doesn't matter which political party is in control. It doesn't matter how good someone's intentions are. Trying to fix the economy by spending massive amounts of money on programs, raising taxes, even cutting taxes and programs leads typically to lackluster results. There will always be winners, there will always be losers. But after all, when we think about it, it's all run by human beings. That's why. So regardless of which policies are adopted, the fact is they could shape the way millions of Americans save, spend, and manage their finances for years. You know, they say the only sure thing in life is death and taxes. Personally, I've always appreciated this quote from Will Rogers. He said, "The difference between death and taxes is death doesn't get worse every time Congress meets." I mean, no truer words have ever been spoken. But the question is this: how can you be on the winning side of all of this constant change and uncertainty? See, the rules of the games, it's changing. All the rules are changing. A plan that you have in place right now, may have paid a lot of money for it, put a lot of thought into it. It all has to be adjusted. And it starts with a basic understanding of simple tax strategies that you can implement right now. You can reduce or eliminate your income taxes without compromising your lifestyle. So here's what you can do about it right now. Visit victorytaxclass.com and register for our free virtual tax masterclass. Now, during this masterclass, we'll talk about several big picture tax strategies that can help you take control and protect yourself no matter what future tax rates look like. And we'll talk about those 3 actions that you can take right now so that they can be made part of the strategy that you have, part of your comprehensive financial plan, taking you to and through retirement. And talking about Tesla, you don't have to be Elon Musk to understand these concepts. They're simple, they're proven, and most importantly, they're effective. Again, visit victorytaxclass.com and register today. As we wrap up this brief episode, I want to remind you that when we stop worrying about the things that you can't control and we start focusing on things that we can control, our life becomes immeasurably better. We can't control what the government does regarding taxes. We can't predict the next major disease that will impact the world, but we can control how we respond to it and how we prepare for it. The best way to take control is to be proactive about your tax planning. And that's why we're here, to help you seize control, to be victorious. On our next episode, we'll be talking all about your retirement and your income. As they say, there is no retirement without income. So how can you create a lifetime of paychecks after you've stopped working? How can you live the lifestyle you want without ever having to worry about running out of money? That and more on our next episode of the Victory, Wealth, and Wisdom Show. But before we go, we always like to end every episode on what we call a positive note. One of the many ways that we give back here at Victory Wealth Services is to help homeless shelters in our local community. In the past, we've held sock drives for our local homeless shelters. We even had a 1950s sock hop. Not only did our clients join us, but many from the community at large showed up to help out and enjoyed a great evening of entertainment and giving. Together, we successfully raised hundreds of pairs of socks. But because of the lockdown, this time we had to reimagine a way to hold our sock drive and to help the community. But that didn't stop Team Victory from making a difference. This time we decided to have a contest. Now, here is how the contest worked. If a person bought a brand new pair of socks and dropped them off, they'd receive one entry to win a prize. Most people brought in socks after socks after socks after reading about our efforts to help the local shelters in the newspaper, or perhaps they heard it on the radio. So the grand prize that we decided to have, because it was very hot at the time, was the Child, a life-size figure from Sideshow Collectibles. Now, since the release of Star Wars series The Mandalorian on Disney+, everything Grogu, or Baby Yoda as many like to call him, have been in high demand. Now, I'm happy to report that because of our clients and the community's generosity, we were able to raise over 400 pairs of socks for our local homeless shelters. That is just unimaginable. We are so grateful for every one of you for helping. Now, you may be wondering who won the grand prize drawing. Well, I'm happy to say it was a young man named Zachary, and he is truly inspirational. He saw the article in a local newspaper about our drive, and he was moved to help us out. So I asked Zachary why he thought socks would be such a good idea to give and to donate to homeless shelters. Look what he says.
Because people need to be warm when they're out in the cold parts of Arizona.
Mm-hmm. So where did you learn to be so charitable, to be so giving?
Well, my dad and my family help with that. They tell me, like, verses from the Bible and things like that.
Excellent. All right. I think we can all agree that this world needs more people like Zachary in it. So congratulations to you, Zachary, and thank you to all of you who participated in this important event that made such a difference. We cannot express our gratitude enough for you. Well, from all of us here at Victory Wealth Services, thank you for watching, and we look forward to seeing you on the next episode of the Victory, Wealth, and Wisdom Show.